Hello everyone, today I'm going to be discussing a topic I enjoy, dividends, but one of the downsides of dividends, which is going to be taxes that you have to pay on dividends. So when you're paying taxes on dividends, dividends fall into two different categories. We have qualified dividends and unqualified dividends. Qualified dividends do have tax advantages. You're going to pay less taxes on dividends if they are qualified, and you're going to pay more taxes if they are unqualified. So going over qualified first, the majority of dividends from US stocks are qualified dividends. So luckily, if you buy Apple or Microsoft or AT&T, stocks like that, basically any US company, the dividends that you receive from those are going to be qualified dividends, so they are taxed less. And they're taxed at long-term capital gains rate. So that's the lower tax. That's going to be a tax advantage. And we'll get into the different tax rates towards the end of the video when I get down to this chart here. So also to have a qualified dividend, the stock that you buy that has a dividend must be held for over 60 days during an 121-day period beginning 60 days before the ex-dividend date. That's a lot to unpack, so I kind of drew out this little graphic here to better explain exactly what's going on with this sentence. By the way, the ex-dividend date is the date at which the shareholder, so if you buy a stock with a dividend, the ex-dividend date is the date you no longer get the next dividend for a stock. So for example, if a stock's ex-dividend date was June 1st, if you bought the stock, let's say mid-May, you bought the stock, then since that's before the ex-dividend date, you would be allowed to have the dividend, the next dividend. But if you bought the stock on June 2nd in this example, it's past the ex-dividend date, so you would not have the opportunity to get the next dividend. You would have to wait for the following dividend to come out to actually receive that dividend payment. So that's what the ex-dividend date is. Now, unwrapping the sentence here, you have to hold this stock for more than 60 days during the 121-day period. So 60 days before June 1st is April 2nd. And then the sentence says this is 60 days before the ex-dividend date is the start of the 121-day period. So 121 days from this April 2nd is August 1st. So this is the 121-day period we'll look at. And then you have to hold the stock more than 60 days within this 121-day period. So this is going to be about 4 months between April 2nd and August 1st, 121 days. So if you hold the stock for more than 60 days within this 120-day period, basically that's saying that the stock is a qualified dividend as long as it meets the other IRS requirements, such as being a US stock. So if you hold the stock for less than 60 days, though, then that would actually fall into the unqualified category just for that next dividend because it's under 60 days. So for that one, it would be taxed as unqualified versus qualified. So just a little thing to keep in mind, not a huge deal. It's only going to impact the next dividend because the following dividend after that, you're going to obviously have held onto it for more than 60 days. So this is kind of just to deter people from buying a stock for the short term, getting a quick dividend out of it, and then paying low taxes. So the IRS doesn't want people to do that. They want to tax any chance they get, basically. So they want you to hold it for more than 60 days within this period for it to be qualified. And going over now to explain unqualified dividends. To start out, they are taxed at the regular income, which would be short-term capital gains. So this is your regular income tax bracket. It usually changes year over year, so it's not always going to be the same, but I have some tax brackets for 2021 data that I just looked up. We'll get to that in a second. And then many foreign stocks are unqualified dividends. So if you're buying stocks from other countries, companies from other countries, those are usually going to be unqualified dividends. And then also REITs are unqualified dividends. So REITs are real estate investment trusts. They usually have a very high dividend yield because they're required to pay the majority of their profits to the REIT holders, and they are always going to be unqualified. So they unfortunately do have a tax disadvantage for that reason. And then getting into the bottom here, we have qualified dividends with their dividend tax rate as well as the income bracket, and unqualified. So just going through it really quick. For the qualified dividends first, if you make between $0 and $40,000 a year, you don't pay any taxes on those dividends that you have because you're in this income bracket. So that's obviously best case scenario. So some people are able to pay zero taxes, which is awesome if you do fall within that income bracket of 0 to 40K. Next one, we have 40K to 446K. You pay 15% on your dividends. So that's obviously going to be a big jump. If you make between that income level, that's going to be a lot of people. So you're going to be paying 15%. And then anything over 446K per year, you're going to be paying 20%. And that is the highest dividend tax rate anyone would have to pay for qualified dividends. Getting down to the unqualified dividends, dividend tax rates. So if you make between 0 and 10K, you have to pay 10% on your dividends. 10K to 40K is 12%, 40K to 86K is 22%. And then there's some others in here that I did not list out. I think there are about 7 different buckets in all. So I skipped down to the most expensive one with the highest dividend tax rate, 37% if you make above 518K of annual income. So obviously, as you can see, based on the numbers, unqualified dividends are going to be less advantageous in terms of taxes, no matter how much income you make. Either way, qualified dividends are always going to be better, depending on your income level. So you always want to try and get qualified dividends whenever you have the opportunity to. Anyways, I hope that kind of explains a lot about the taxes on dividends based on qualified or unqualified. You always want to try and get qualified when you can. They do offer a tax advantage. If you have any questions, let me know.